Are you ready? Are you ready? I saw you were with them last night.
Yeah, that is Engaging Time, coming to the Fairmont Shores Restaurant in Fox Lake, Illinois, this coming Sunday, July 28th and August 11th, from 2 to 5 in the afternoon. I hope to see you. If you see somebody with a cowboy hat trying to play guitar, that's me. So I hope I see some of my friends and colleagues and neighbors out there, so we'll see how it goes. Quite honestly, there's not been a lot of promotion with this because I literally just found out the last 24 hours or thereabouts. Anyway, back to the show. This is 101.5 FM, WLCB, Slade's Corner, Wisconsin. This is your Insurance Corner, and we are continuing our discussion with regard to types of life insurance policies. So we just covered term. One last thing about term insurance, just for the record, and I kind of did touch on it before. Most employers, not all of them, but the vast majority of them, will offer some kind of term life insurance policy. They will typically buy a group plan that may be a flat 10, 20, up to 100,000, maybe a multiple of salary. The bigger the company, the more robust the policy will be. But it will always be term. It will always be term insurance. And there are portable features to those in the corporate world. There is also voluntary life insurance where on top of the guarantee issue or the employer-sponsored plan, there's term insurance that you can buy that is a multiple of your salary. Let's say 5 times your salary up to $200,000 guarantee issue, which means no questions asked. You could have a multiple of medical issues. You could have cancer or MS or name your medical condition. No questions asked. Sign the piece of paper. Do your beneficiaries. It's all good. In the corporate world, those kinds of policies are portable in many cases. Not all, but in many. And what that means is that you'd have to call the insurance company within 30 days of your termination of employment to see what it costs to take the policy with you. The premiums may be the same as what you were being billed, or they could be a little bit higher. Not much higher, quite honestly, but a little higher. But here's the thing that you need to be aware of. Typically, most voluntary policies are on a every 5-year chassis. So at 35, the policy premium is going to change. At 40, it's going to change. At 45, it's going to change. And the older you get, the more expensive it's going to get. So you just need to be aware of the moving parts of that. It basically works the same, looks the same as a term life insurance policy, nothing different, nothing fancy. There are conversion features oftentimes in these things. So just like being able to convert a policy that you bought on your own that is convertible, these policies that you buy from the employer are also convertible. So let's talk now about, so that's term. Basically renting the policy, it goes from point A to point B, and then you have to start all over again. Permanent policies. Let's talk about the different types of permanent policies. And quite frankly, folks, given the fact we've got about 20 minutes left in the show, we're going to stay with the whole life policy first, and then meander through the rest of the policies in our next show. So, but here are the different types of policies. I came up with 5 types of whole life policies. Oh, you know what? I forgot to mention something. Let me go back to term insurance one time more. Mortgage insurance. I did mention that at the beginning. What is mortgage insurance? It's a fancy way of calling it term insurance. Whether you buy the mortgage insurance from the bank or you buy it on your own, it's typically a decreasing term insurance policy that is tied to the mortgage. The reason I don't like this is twofold. One, the beneficiary to that life insurance policy is not your family, it's the bank. The bank has got a get out of jail free card if you pass away. The mortgage is paid, that's a good thing, theoretically. The bad news is the money does not get deposited in the family's account, it goes right to the bank. That's the first thing. It's a decreasing term policy, assuming you never touch the mortgage. You buy a 30-year mortgage and you let it ride. But the vast majority of us folks don't. We tinker with home equity loans and maybe we buy and sell houses. So that mortgage policy that you bought when you bought your first house is frankly useless when it goes to the next house. In fact, if that mortgage policy is still in existence and the beneficiary is, let's say, Bank of America, they're going to get that money tax-free. It's not necessarily tied to, it is tied to the mortgage per se, but the beneficiary is still listed as Bank of America. The bank's going to get that money, not your loved ones, not the new bank who's got the new mortgage, etc. So I would just be very cautious when you hear the word mortgage insurance. Don't get caught up. It's a term policy, and you really just need to understand how those policies work. All right, so let's move on to permanent. There are 5 types, from my vantage point, of permanent policies. First is a whole life policy. A second is a universal life policy. A third is an indexed universal life policy. A fourth is a variable universal life or a variable whole life policy. And the last one is a graded whole life policy. So let's start with the whole life. And I want to just mention in an asterisk here that you can have a whole life policy that's graded, or I like to use the word blended. We're going to define that in the next several minutes here as we go through the definitions. So whole life. The first thing I'm going to tell you about whole life, folks, is that there's only a few companies in this country that do that are very good at this. I'm not going to say who they are. I can tell you off the top of my head, but I'm not here to commercialize them. I will just tell you there's only a few companies in the country that are very good at whole life policies. There may be other companies that offer them, but frankly, there's like the top 5, and then after that, the cliff gets pretty deep. So premiums are fixed. Generally speaking, whole life policy, not generally, 99.9% of the time, those premiums are fixed for life. So if you buy a whole life policy at 30 years old and it's $200 a month, when you're 65, that policy is still $200 a month, and you've got some other assets built into it, which we'll talk about in a second. But that premium is fixed. It will never, never, never change. They are dividend-based. If you're buying a whole life policy, you're basically buying the profitability of that life insurance company. If they're profitable, the dividend that they kick out at the end of each year, based on their board of directors meetings, then is parsed out and delivered back to their policyholders. Why? Because a whole life policy typically is a shareholder of that life insurance company. That's right. If you're a whole life policy member, particularly with, let's say, the big 5, you are actually a de facto owner by shares of that life insurance company, because they're not public companies, they're private. And the private companies kick out a dividend, no different than a stock. The dividend is shared with all the policyholders. The dividend goes into the policy, and depending on how the policy is structured, either buys more life insurance and or increases the cash value. So not only the dividends accruing in the policy year after year, but it's helping to beef up the life insurance death benefit and certainly beef up the cash value in the program. That's called paid-up additions. That's what that's called. Now, some advisors don't like paid-up additions. Others do. I like them because the idea here is to build up the death benefit. It's kind of an inflationary protection mechanism so that you can actually see that the death benefit is going up and might very well be keeping up with inflation. A term policy is never going to increase. If you bought $1 million 15 years ago, it's still $1 million on the 16th year. The inflationary impact on that $1 million certainly has had an impact on itself, but at least it's a big number, and you can buy a lot of term insurance for a little bit of money. Whole life insurance is a whole different matter. I'll just use a kid's policy as an example. You can typically buy a good whole life policy for $50 a month for a child and buy $100,000 of life insurance. And you put some other things in there. I'm not going to get into it at the moment, but you put some other riders in there. And that policy is $50 forever. And that policy will be significantly larger, and the cash value will be significantly larger when he's 25 years old, and then 40 years old, and then 65 years old, etc. So the dividends go and pay additional life insurance and add to the cash value. The cash value in a whole life policy grows tax deferred. That's important. Congress knows that this is a cash cow for a lot of people, not just the wealthy. The wealthy do, in fact, use this kind of a program for other things. And if there's time, and I don't know if we're going to get there tonight or not, but if there's time, we're going to go over the reasons why the super wealthy may use a whole life policy instead of investment proceeds. So you can buy more life insurance. I already talked about that. The dividends buy more cash value. The cash value grows tax deferred, and it grows over time. There can be an advanced death benefit baked into this policy. Quite honestly, I've not seen those before, but there's a possibility that could exist. This one's a big deal, folks. The waiver of premium policy, now that the premiums are significantly higher, if you become sick or disabled for 6 to 9 months, again, and depending on the company, and you're totally disabled, if you're spending $1,000 a month, and don't roll your eyes, that there's a lot of people that spend $500, $1,000, $2,000, $5,000 a month and more on these kinds of policies because they can, and they understand the dynamics of how they work. But a waiver of premium says if you become sick or disabled, the insurance carrier will pay that policy. Now, with term insurance, it might be a couple $100 a month. With whole life insurance, it could be $5,000 a month. That's $60,000 a year. And if you're not able to work, that's free money, folks. And it's tax-free to you. You're not paying a dime. That's an insurance policy baked into the whole life policy so that that policy can stay afloat. If you want to use the policy for certain things, a lot of people use them to build cash value. So they do what's called overfunding the policy. Now, with whole life, it's a little trickier to do that because of the way a whole life policy is built up. You either have to blend it with term insurance, or you have to find a different methodology, or you just pay more and buy more death benefit. That's typically in a whole life policy what's going to happen. If you wanted $500,000 of whole life and it was going to cost you $3,000 a year, and you're like, okay, maybe I want $1 million. Well, now it's going to cost you $6,000 a year. The dynamics are going to be the same. You've got more death benefit. The premium is still fixed. But the cash value is what the person's after. Why? Because he might be using it, or she might be using it to fund college education. A favorite use if it's done correctly at the right time, particularly when the kids are younger. It can be used to supplement your retirement. Yes, it can. It can be used to supplement your retirement, and the money from the cash value, when you're ready to pull the trigger on that subject matter, comes out income tax free. And you still have a life insurance policy that's tied to this. So if you're doing it for the purposes of supplementing your retirement, good call. Took some discipline to do that because it's not cheap to do this. but you're going to get income tax free, and if it's done correctly with the help of the advisor or the life insurance company, you may be able to extend that thing out for years before it could blow up on you. And if you do it the right way, it shouldn't ever blow up. And here's part of the reason why. Those dividends are helping to support the policy. Even if you stop paying into it, the dividends may be enough to support the policy indefinitely, even though you're taking loans out of the policy. Now, I just said a word that I didn't say before. When you're taking money out of the policy, you're taking a loan. Sometimes you can withdraw it, to different subject matter, but loans, you can take about 80% of the money out before the policy starts to get interrupted. If you're taking a loan, the insurance company is going to charge you an interest rate. If you're doing it for retirement purposes, you can choose to pay the interest back or not. You just have to pay attention to it so the interest doesn't overwhelm the policy. If you're taking out loans, it's going to be somewhere between a 4% and 8% interest rate. And generally speaking, if you're taking out loans and you just pay the annual interest, the loan, unless you're taking out more money, is not going to get any bigger or any worse. If the interest is paid, if the interest is not paid, however, and you took too much out, now it's a bigger problem. The loan gets bigger, and eventually it can become a tax bomb. Because if you do take out too much money, and the policy no longer can support itself with the dividends, the policy will blow up. I promise you, it will blow up. And the money that you took out now becomes a 1099 income to you. You were taking it out tax-free. You thought you were doing it the right thing. You took out too much, and it becomes a bomb. So you really have to be careful and get good advice as to how to structure it. Honestly, no different than a 401k, folks. Let me explain why. If you're sitting on $1 million and you follow the 4% rule, you're going to pull $40,000 out a year. And that's assuming a certain interest rate that you're going to assume you're getting on that portfolio. But what if the portfolio takes a hit and you lost 40%? Now your $1 million is down to $600,000. If you're still wanting to keep $40,000 a year coming in, you're in trouble. You're going to run out of money. It's not complicated. It's simple math. If we follow the 4% rule based on $600,000, instead of getting $40,000 a year, now you're only getting $24,000 a year. Your portfolio might be able to hang in there so long as it doesn't go down anymore, but now you just took a $16,000 a year haircut. You might be looking to go back to work when you don't want to. So you can run out of money. In both cases, theoretically, you can run out of money. But if you structure the whole life policy correctly, you shouldn't run out of money. The other part that you can do with the cash value, let's say you no longer need the life insurance policy in a whole life program. You no longer need it. The death benefit was there for your spouse and or your kids or the college or maybe to supplement your retirement, but you're looking at the loans and they're starting to accrue and you're like, this is not a really good idea. What else can I do with the money? If you withdraw it, you're going to pay taxes no different than a savings account. You put in $100,000, it's worth $300,000. You're going to pull out the $300,000. You're going to pay taxes on $200,000, and that's going to be income taxable at your income tax rate. You can take the cash value out of the policy. You can, and do what's called a 1035 exchange and roll it into an annuity. And what happens then is that you can turn on the annuity stream, and then I can absolutely guarantee you will not run out of income. It will be structured perfectly for you so that whether you live for 2 more years or 100 more years, you're going to get that same income stream no matter what. No matter what. And in some cases, if you do have the right provisions in certain contracts and you end up getting into a nursing home or home health care situation, you may be able to dive into the principal and invade the principal, no penalties if there's still penalties involved. So there are ways in which you can design these things so that a whole life policy then becomes an income stream either on its own with a life insurance, which, by the way, is distributed still income tax free even if you're taking money out, or the money's moved out of the life insurance policy, you collapse that policy and move it into an annuity. I don't think that it's a real good idea just to cash it in. Your income tax threshold is going to go up, and if you're already on Medicare, that's going to screw up a whole bunch of other things, like your IRMA tax we've talked about in the past. So we're coming up to the top of the hour, and as I predicted, we are running out of time, and there is a message that I wanted to promulgate, and I'm going to probably use all of 4 minutes. So, nobody called in. You can still call in if you want at 262-342-6588. But in the meantime, let me find this little message that I had. I have to find it here, so bear with me. There's some music in the background because of where it's coming from. And the title is How to Be Mentally Strong. Okay, well, it's not doing the music, so that's good. Don't fear alone time. Don't fear alone time. Take advantage of it. Don't dwell on the past. The past is the past. There's no time machine that's going to send you backwards to fix things. Don't feel the world owes you. The only thing you owe is to yourself and maybe your family. There's no such thing as keeping up with the Joneses. That often ends in disaster. Don't expect immediate results. And that's a big one, folks, because we live in an immediate gratification environment these days. Everybody wants it now, yesterday, and the day before, and they want it for free. Don't expect immediate results. Don't worry about pleasing everyone. Impossible. Impossible. Make sure you're happy first, because if you're not happy, nobody else is happy. The only exception to that might be happy wife, happy life. Make sure your spouse is happy, and the rest of it will take care of itself, I hope. Don't waste time feeling sorry for yourself. Nobody cares. Maybe your immediate family cares, but at some point they're going to ask you to get your head out of your butt. Don't waste energy on things you can't control. Oh my gosh, I say this all the time. If you can't control it, don't worry about it. Don't let others influence your emotions. This is the proverbial keeping up with the Joneses. You do you. Do your best. Work hard, play hard. Care about the people that are around you, that are in your immediate vicinity. If you've got close friends, care about them too. But don't make a decision based on a knee-jerk reaction that may not go very well. Don't resent other people's success. That's their success. Maybe emulate them, find out what they did, and make it your own. But you don't know what they went through to get there. Make it your own. Don't resent other people's success. Don't shy away from responsibilities. Big deal, folks. Don't shy away from them. Give up after the first failure, or don't give up. don't give up after the first failure. Little known story. Albert Einstein, I think, failed 9,000 times before he created the light bulb. The guy who created the Nautilus weightlifting system back in the day went bankrupt 5 times before he got it going. And there are probably countless other CEOs, small and large, that have failed and pulled themselves up by their bootstraps. So don't give up after the first failure. Don't fear taking calculated risks. You can't move the ball unless you're willing to move outside the box. If you stay in the box, you're going to get what you deserve, and what you deserve is what you asked for. If you're not willing to expand the comfort zone. So make sure you've thought it through. It's not going to guarantee you're going to be successful, but think it through. And that's it. So at 101.5 FM, WLCB, this is your Insurance Corner. Have a great night, everybody, and we'll see you, I think, next Tuesday. Hopefully we'll see you at Fairmount Shores on Sunday from 2 to 5. Have a great night, everybody.